The Hedgeless Horseman here. It's January 4th, 2025, first video of the new year. Happy New Year, and I hope you had a pleasant holiday. First of all, thanks to the sponsors. New one is Irving Resources. So we have a new year. Gold ended at about 2600 at least. Silver climbed up. I think it actually closed below 30 in 2024. I'm not 100% sure. I didn't watch the metal prices that much last 2 weeks. Bitcoin under 100,000. Anyway, so I thought I would just go through a few slides. Basically, just recapping the philosophy of value investing or contrarian investing. You could call it copium, even though it's more like common sensium, I would say. And the goal, of course, is that, the goal is that we really shouldn't need copium. But, sometimes we actually do. Or I see it more like you need to remind yourself that what you're doing is correct, despite the fact that the market is suggesting, maybe for a very long time, that you're not doing something correct. That's the tricky thing with investing. It's like in theory comes first, results come later, in a sense that you have to follow a strategy, and there's no real guarantees. Nobody knows what's going to happen. So you kind of have to just make up, I was going to say some rules, but it's like an investing strategy that makes sense. And then over the long term, you're going to find out if you had a good investing strategy or not. Because you obviously nobody knows what stock you're going to make money on, with 100% certainty. And nobody would obviously own a stock if you think, well, I'm never going to make money on this, but still we do. So it's really, it is a leap of faith. Everything is a leap of faith. But if you have that backed with a game plan, it's like, why did you actually buy this? Okay, not knowing, or knowing that there's never a 100% guarantee you're going to make money. But if the theory behind it is sound, you might not make money on that stock or in that case or whatever. But over time, you'll win more than you'll lose. That's a good strategy. So I think it's good to remind ourselves of that, especially again when sentiment is bad and you should be buying, but you don't feel like buying because everyone is bearish and it feels like nothing is ever going to revalue higher. That's when you really, I guess, would need copium, in the sense of reminding yourself, like, why do they say buy low, sell high? Why is this going to come back? Why is this time, why is it a good time to buy? So, it's really more reaffirming that this is a strategy that works. And then that kind of becomes copium, I guess, because you get reminders like, right, this is why I should be holding, this is why I should be buying. And even, despite the fact that maybe the, portfolio looks terrible over the last 2 years or whatever the case might be. And of course, like, everybody should know by now that, what do they say, like 1 in 20 beat an index over time. It's basically 1 in 20 active investors can outperform an index. In the junior sector, given how volatile it is, I would pretty much, and plus, the index itself is crappy because most junior companies, I would say, 80-90%, they're not going to be around in 10 years, stuff like that. So, the index itself is a value destroyer, one could say. So, the trend is down, really. So, in a bear market, for example, in junior miners, when the average or median junior is down 70-80%, I mean, if you're only down 50%, you're outperforming an index. It's just that the index itself has done so poorly that even if you're just down 50%, it doesn't really look like a victory, even though it, in a sense, it is, because the median junior is down a lot more. So those are things you have to also keep in mind, and that's why this sector is so brutal mentally. Because even if you're, let's say, outperforming, it can look terrible, but you're not going to be, investing in, stock picking S&P 500 companies, and if you're outperforming the index, you're not going to be down 50% pretty much ever. I mean, because that doesn't typically happen. It's just that's the playing field we're in. We are in the most brutal one. We are in the most volatile sector. We are in one of the hardest sectors in a sense, because there's so many types of risks. And yeah, huge sentiment swings, etc. I mean, you kind of have to love the challenge of it all. The thing is, of course, that a volatile sector is a sector that makes a lot of mistakes, because value doesn't swing like juniors swing, like the prices of juniors swing. And I mean, we're gonna look at that later on. First of all, we have just gone out of December, and I don't know, most people, I guess, would be familiar with the idea of tax loss selling silly season, which basically culminates in December typically. This is a seasonality chart for GDXJ, I'm pretty sure, over 13 years. So from a seasonality standpoint, you would expect your junior portfolio to show the worst numbers in mid-December. And that's, of course, when people, especially if it's been a bad year, which happens a lot in the junior space, especially since I think we're out of the bear market, but for the last 4 years, it has been decreasing sentiment in this sector. So typically, I mean, given value gets valued less. I mean, gets discounted more, increasingly so over 4 years. But just looking at this, 2 weeks ago would be the worst time to sell from a seasonality standpoint, and the best time to buy. But of course, people are, you don't typically see that, because people, again, buy into what Mr. Market is selling. I mean, I get sometimes messages from people like, a stock is down 5% on nothing. A junior, it's like, has anything happened or whatever. It's like those are people who don't understand how markets function, or especially the junior sector functions. Most daily moves are absolute noise, absolute bullshit news. If a stock goes up 5% on no news, I mean, that's an incredible move in reality. And same if it goes down, and sometimes they can go up 10 or 20% or down 10 or 20%. That's an insane compounding rate. I mean, people should be happy with 20%, very happy with if you could compound at 20% per year. So those are, again, weird moves, volatile moves don't really make much sense, but that's just people voting with their feet. And let's keep in mind that, especially, I mean, going into lows, for example, I mean, the future expected returns go up exponentially as price declines, even if it, declines linearly. So if somebody has a stock that they're down on, and they just want to write off the profits, I mean, they don't really care what price they're selling. They're not selling because they think it's overvalued. They're selling because they're down on it, maybe a lot. So maybe they bring it down 10% more. That, if somebody picked up shares from that person who did the artificial selling, if you get a 10% discount compared to whatever 2 days ago, because somebody sold it from a tax loss selling reason, that extra 10% discount might be an extra 50% plus on that purchase in the future, relative to a purchase 2 days ago when it wasn't down an extra 10%. So it's just insane, really, the opportunities that shows up at lows. And it's even better in a sense that when you have something that's already maybe very cheap because it's gone down in price, people sell it for no other reason than to book a tax loss. So those buys can be extremely good. But a lot of people forget that. Again, they take it personally. It's like the market knows something, and they, of course, get paranoid. It's like, oh, it's my portfolio is going down even more. That means everybody's expecting the juniors to be terrible for the next 2 years, so they don't buy. Which is, of course, in my opinion, not something you should be doing. If it's cheap, it's cheap. I don't really care the reason for it, or I mean the narrative for it, I was going to say. Another, somebody tagged me in this from Hedgehog Trader. TSX Venture divided by, I guess, GLD. So it's basically TSXV, divided by gold. And like, wow, after 4 years, Canadian venture stocks are starting to break out versus gold. A great sign for cheap microcaps across sectors in gold, silver, copper, lithium, crypto, and many other assets. So it's not only miners, of course. But hey, I mean, I wouldn't invest based on this. I don't really make any decision based on short-term or charts. It's like what I say, about traders. I mean, if you're not a trader, you're kind of supposed to. I mean, you're supposed to take advantage of traders, because let's say this is some kind of trend line that some funds or traders are respecting, so they're keeping it in this channel. I mean, there's some companies out there that almost looks like a machine has, let's say, shorted them. It's like a perfect channel, for example. Maybe the value, if we pretended this was actually a stock, maybe the value up here was here, and it's maybe gone down. Let's say metals have gone down. In this case, gold has actually gone up. But let's pretend it has trended down, but the price has trended down more, and people see these, respect these trend lines, whatever. So the traders are in control because there's so few contrarian buyers, so they can't really take advantage of the increasing gap, or the few that don't have the ammunition, let's say, to actually keep the market honest. So it just gets cheaper and cheaper. And it's like, you can look at that as, oh, this is such a curse. If you thought it was really cheap here, you bought it, just went down more and more. Because of, again, traders, like, okay, they sell it here, short, whatever, maybe cover some, and then it goes up here, and they do it again. And then you're like, oh, what a curse, I'm down, whatever, 40% from when I thought it was already cheap. I was like, if you know the case well, let's say, if you have conviction, it's like, this is just an increasing price to value gap in that case. So in the short term, you will have bigger paper losses and you will look stupid. But in doing so, the traders have created an increasingly good opportunity. So whereas you bought this stock here, let's say you put in 1% of your portfolio, because you like the risk reward, you think it's worth this much, you bought it here, and then it goes down more. So your 1% position is down to 0.6% or something. Thanks to the traders, whatever, the sentiment, all of that mumbo jumbo that makes the market do what the market does. But all of a sudden down here, it's like you read up on the case again, you look through the your thesis, and you're like, okay, I still think it's worth this much, but now price is down here, so the risk reward has gone up exponentially. Because now you only pay whatever, like 20 cents on the dollar in your opinion instead of 40 cents on the dollar. And of course the downside is capped. It's always capped. The downside from 40 cents per share to zero is 100%, and the same is for 20 cents to zero. That's 100% decline. upside though, if you're right, if you think it's worth $1, um, the upside is now 400%. So if you're right, you're gonna make, or quote right, if you're right and look right, that's the thing. It's like even the stocks you make money on, you're never really sure if it was a good buy or sell. You just see what happens. So that's again goes back to the theory comes first. Because I think I've lost money on cases I think are good and would invest in. Again, it's like I can't really see an obvious flaw in my thesis for it. And I made money in pretty crap companies where I get lucky with, let's say, a sentiment swing or something happens I had no idea about. I mean, take what's the name of it now? Hercules Mel. I think they're called metals now. I bought it for some silver and some silver beta and some exploration, whatever. I get into a financing. I just thought it was cheap. Okay, I thought it was cheap at the time. Got full warrant. Then they made a copper discovery. The stock goes up. I don't know, 800%. Was that in my thesis? No, not really. I mean, that's not why I bought it. I bought it because it was cheap, and I thought, hey, just if silver performs or whatever, it was more of a beta stock, but they had some exploration potential and the target looked big, whatever. But I didn't really invest specifically for like, oh, I think they have. I'm buying this for the copper potential, the porphyry potential. It just happened, and then you make money on it. The thing is, it should be I mean, a strategy is something you should be able to repeatedly do in a sense. The thing though is, the important thing is, when you buy cheap, you leave a lot of room for upside surprises. That's the thing. You don't know maybe exactly what might could go right, but if it's cheap, uh, you can make a lot of money, which is going to pay for a lot of stores that don't pan out or where they don't make a discovery, etc. So it's like buying cheap, like down here, is our best offense, or I mean, here for example, is our best offense because that means more room for upside surprises. You need less upside surprises to make the current market cap look cheap. Um, and yeah, and also defense in a sense, because especially if there's margin of safety. I mean, if you pay very little for what is, let's say, already known, if they have success, if they have tangible success already, in a sense, there's no there's no obvious downside risk over the longer term. Shorter term, again, even if this company, for example, was worth this much, it still went down, let's say, 40% or whatever. So there's no guarantee that you're not going to have paper losses. It's just that over the longer period, when the sentiment swings around again, when we go from decreasing sentiment to increasing sentiment, odds are you're going to be able to sell at some point in time, sell the stock for a profit. That's the thing. So you stack the odds of that happening in your favor when you buy sentiment extremes at lows, obviously, because the next big change, I mean, the worse the sentiment goes, I mean, at some point, it's so bad that even decent sentiment means that the stocks are up 100%, for example. So it's the best offense and defense. This is a bit outdated right now, but it's also the TSXV. I just found this chart. I mean, look at the volumes. And I've shown it before. It's like from there was a shortest textbook, TA textbook, where they showed like, what do you call it, like bull trap and the depression, and it's like hope and whatever. I mean, this looks like I don't know exactly how it looks now. I think it's maybe up a bit, but it's like, okay, a multi-year, like, reverse head and shoulder bottoming pattern with abysmal volumes. So I mean, if you were only a contrarian, you looked at a chart like, okay, what does depression, what does a cheap sector look like, or a cheap index, or a lowly price index where the risks are going to the upside? I mean, this would be it basically. And the interest is like waning basically. Perfect, great. There's, I mean, everybody is sold basically. Everybody is sold. And you know, like forever markets are going to be cyclical. So it's like, where do you think the big move is going to be? This is a crashed index with record low interest. What is the big change? What direction could the big change? So if this sector, this index is dead, there's no interest. Uh, can it get even more dead and the interest can go even lower? Yeah, I mean, sure, that's possible. I mean, it was low here and then it went down there. But in the grand scheme of things, the big change is obviously going from extreme depression to euphoria, and this would be euphoria. So the big delta is obviously to the upside, it's not to the downside, and this sector is, this index is never going to go away, even though that's how it feels like when you see this kind of thing. I mean, if you bought it here, I mean, what's there to say? I mean, if you bought it here and let's say you look wrong or whatever, or you bought it here and you look wrong and you held it to here, should the fact that you bought it here and have suffered through all of this change how you look at this point? No, it shouldn't. The past is past. This is water under the bridge. This is spilled milk already. That's one thing that it's very important, because there's a bunch of psychological mistakes we do because we're humans that makes no sense in reality. Let's say if you weren't invested in the, let's say, mining sector, whatever, you just find it here and it's like, oh man, if somebody showed me a chart, like what would possibly the best time to buy be? Yeah, maybe here, let's say, but you don't do it because you bought here and have suffered through this period. You're shooting yourself in the foot, obviously. What has happened should have no bearing on where we are, the decision that makes sense here. I mean, if you bought here and you're down here, what was I gonna say? I mean, yeah. So if you have had terrible, absolutely like quick and huge losses, this is still the best time to buy in this time span here. But if you don't do that because your recent past is so terrible, I mean, you're not doing yourself any favors, obviously. And that's just typically what tends to happen. The best buys tend to be after the worst past. Insanely bad recent past. Then came a pretty humongous rally. And this is a long and bad past. This was huge losses, but relatively quick time. This is like maybe the mother of all, I don't know, bottoming formations. I mean, this is a bear market from, so like 13 years or 14 years. That's I mean, the amount of pain in this chart is just immense. So you can imagine what could happen after when that turns around. I was gonna go through a few bullet points. I didn't come up with a lot. The most important thing, which again I think a lot of I think this is the number one thing that people don't do, and it might be because let's face it, most people are traders. Most people are momentum followers. Every single holding I own is because I like the risk reward in that particular stock, and there are different cases for each stock. Some might be micro cap companies with no real margin of safety, but the idea is maybe get into, let's say, cheap placement and get some warrants, and the idea is like, hey, if the sector turns around within the next 2 years, let's say the warrant period is 2 years, somebody could sneeze on this stock, it would be up 100%. If we would go into a good sentiment environment, when no company is trading below 10 cents or 10 million or whatever, I might make 300%. And again, given where we are, I mean, that's the sensitivity to the upside is increasing. I mean, it takes less and less buying power to get them up. and some of bigger positions typically they tend to have margin of safety, at least they have probable growth. So the smallest positions are real long shots, like, okay, what are the odds of this micro cap company making a significant discovery with tangible value? That's got to be low, let's say 5 to 10%. I mean, that might be even on the high side. So that's from a technical perspective. What's the chance of a technical, long-lasting success? They find a tier 2 deposit, and the tier 2 deposit is going to stay a tier 2 deposit or a tier 1 deposit. Those odds are very low. But you also have in the back pocket, given from the where you pick them up, the sentiment levels. That's basically a second chance, let's say, at least selling for a profit. Because they don't necessarily need to make that discovery. If this sector just turns around from a sentiment perspective, you know what happens with these microcappers. I mean, some of them can have the best returns, but also they can absolutely get killed. They might run out of money, etc., etc. That's why they're not big positions. But that's the thing with, again, buying into a lowly valued environment, especially a sentiment-driven sector where prices are low. So you get, I mean, it's basically an accident waiting to happen on the upside. You just don't know when. And that's not necessarily related with the actual news of the company. So a company can make a discovery, but it can also not make a discovery and not do much of anything. But if the sentiment turns around, you could have returns like they made a discovery. If you get both, I mean, that's the holy grail in a sense from a absolute return perspective. But at the same time, I don't want to be greedy and just put everything in microcap companies because they can do the best. Because I mean, if this goes on for, let's say, 1-2 years or something, I mean, low liquidity, you can't really get out, not much happens. Again, maybe they run out of money, maybe something happens, yada yada yada. I don't want to waste the mother of all value opportunities by buying just speculative things. Because in a sense, if you have a pre-discovery play, for example, yes, there is risk-adjusted values. Like, okay, if there's a 5% chance that they're going to find something worth 500 million, that's obviously a pretty high number. But it's still very speculative. With that said, yes, theoretically, if you found 50 microcappers that were pricing in 1% chance of discovering something, and you think it's more like 5%, that portfolio would be 400% undervalued. And if you're right that the average success rate is around 5%, that portfolio should do well if you have 50 different cases. How easy and nice of a ride is that to do, and especially since you can't really sell any of them anyway, not easily. Well, I guess if you spread it out over 50 plays, you might be able to, because the positions would be like 2%. Still, it's not my preferred way of going about it. Following 50 early stage companies, I mean, that's just a lot of work, but I guess that goes to show there's so many different ways to skin a cat, and even in a very cheap sector, low sentiment, you could have high risk plays that, I mean, make sense on paper and all that. I personally prefer, especially at a time like this, I prefer to focus more on the margin of safety plays, where I think to already have something of value, of tangible value, it's probably worth a lot more than what I'm paying for it. If I can get free optionality on that, that's great, because in a sense I get an exploration story for free, risk free, and I have probable returns from the margin of safety. I think those are the kings of the risk reward kingdom right now, for obvious reasons, like what Pierre Lassonde said. Give me optionality and give me free optionality and I'll make you a millionaire. So those are, I would say, kind of the holy grail of risk reward, and also they're like that's I was gonna say all weather strategy that works. I mean, you don't need to own like 50 high risk juniors to make it make sense from a diversification standpoint. You might, hey, I mean, if you find five solid juniors, I mean, you could probably put 20% in each of them, because if they all have like, I don't know, 2 3 400% of probable returns, you think they will be around for the next sentiment swing, and they all have like material expiration potential as well. Yeah, I mean, you probably might make money on out of five of them. You might need to have the base case play out from two out of five of them, and all of them have that free optionality potential, where it's like, okay, your base case is that they're going to go up to 300%, whatever, each one of them, but they can also go up 10x, for example. And then obviously you only need one. I mean, one would pay for more than I mean, one would pay for all the losers, even if the losers went down 100%, and that's probably not going to happen if you have pretty solid cases with very probable or tangible margin of safety. So there's a bunch of different ways to play it. Obviously, I just prefer, again, my view of it right now, given how high the gold price is, how high the gold mining margins are. So it's like a proven gold deposit right now has never been worth more, in a sense, on paper, and you can still buy it for kind of pennies on the dollar. So that's what I like. If I would, I mean, basically, if we pretend this is the margin of safety, this is the free expiration upside, and you're paying this much for the company, so this is the price now. So you think what's already proven in the company, or what you think will at least be proven, like tangible and probable value might be up here. So this is basically the upside surprise waiting to happen, just waiting for sentiment to come around, whatever. And you don't expect this one to go bankrupt or anything like that. You don't see any necessarily like killers of the case. So then you bought it mainly because of this price to tangible or probable value gap. So then you're just going to hold it until price is somewhere close to this. But you might have whatever, like it might be a growth play as well. So it's like you think that it's actually going to trend up, but then you also have the like free optionality that maybe some grassroots targets or whatever that you might be 20% chance of happening, or maybe you have a bunch of different angles where it's like, okay, they have 2-3 targets, and 20% on each of them, yada yada. So the chance of making some one discovery there is what is it like compounding 20% over 3. So it's like the odds of not discovering anything is pretty low compared to if they only had one target with a 20% chance of success or something like that. But the idea is that if this is intrinsic value right now, or probable value, this is the price to value gap you get intrinsically from the start. But then you would obviously prefer companies to have this free optionality on top of that. Because you could obviously just buy a bunch of these companies, and you would expect to, on average, make the return difference to the sum of the gap here. But if you find a bunch of companies with this free extra expiration upside that you're not paying anything for, because you're not even paying full value for what is already known, obviously you would expect that portfolio to do even better. If you had a portfolio with 20 cases like this compared to somebody with 20 cases like this, this portfolio, if you could just continuously find stories like this, where you have this much added free optionality. This portfolio is going to blow this portfolio way over the long term, because sooner or later, now and then, this free optionality is actually going to materialize. So you have this, like, let's say this is a 3-bagger. This is a probable 3-bagger with a potential 8-bagger. Some of those are going to work out, and you're going to get a much higher return in those stories than these ones that are kind of capped. And I mean, if you get 1 in 4 or whatever, that's going to add up a lot over the long term. So we obviously want to stack as much in our favor as possible. So focus on the company, because there's no case that is exactly the same. We want to find, in my opinion, cases where there's a lot of things we want to know the case better than the market. Because let's face it, I mean, the market is the marginal investor. What does the marginal investor care about? And I'm doing a piece on this right now, actually. They focus on the next news release. That's basically it. They focus on the next news release. They focus on what they think the next move for gold is going to be. They focus on what they think the next short-term move in the stock price of that company is going to be. That's the stuff that basically drives the market on any given day. But we want to look out farther ahead of that, and I'm going to get to that. This is I found this in my slide folder, basically. I mean, this is basically a good representation. And if you have a cyclical sector, you're going to have a lot of these things. So the idea is, again, if we're a stock picker, the idea is to get a sense, what do we think this company is worth? And again, that's why it's like, I see people complaining to me about this sector. It's like, oh, this sector is so shit, you can't make money in it, I'm waiting to get out, yada yada. It's like, you can obviously tell they have no idea what they own. They don't know why they bought something. They think, I mean, there's like some guy, for example, who whines on Twitter a lot of the times, like every other day. He thinks him and me should have the same returns. That's what it seems like. Because we're both in junior miners. So he's looking at his portfolio, he's looking at the average or median junior, and he just assumes like, okay, everybody should have his returns, because he's also in junior miners. So if I'm in junior miners, how in the world could I have better returns than him, for example? That's a very arrogant way of thinking about it, obviously, because like, how much work did he do? I don't see him mentioning anything about the companies he owns, why he owns them, or anything like that. He's just whining. He's just bitching about the sector. Does that guy deserve any sort of returns? I wouldn't think so. It seems that he just bought into a narrative. Let's say it's like, juniors can go up a lot, and they can. And then he just bought a few juniors, has no idea what the juniors are doing, doesn't know what he wants to see from the company or whatever. So maybe he just bought some stocks, and then he doesn't really, follow up on the case, whatever. And he has no idea how cyclicality works, because he's bitching about here, for example. I don't remember exactly what stock this is, but this is I think it's a silver junior. This is what we have. This is I don't even know if this is, I think this is like late 2024, something like that. This is a cyclical sector. And yes, since 2020, we've had a downtrend. Same as from the 16, 17 top to the like 2019 bottom. So that was like 3 years. Now we're, depending on where you look at it, it's like I think we're at like four years or something. This was even worse. I mean, I think this is 2011 down to 2015. The thing is, this is a cyclical sector. It never stays down. After the crash has happened, the next big move is going to be up. After the crash has happened, the next big move is going to be up. After the crash. So if you just know that, this is an accident waiting to happen on the up side. But how many actually know that, or grasp that, or can internalize that? I know I'm sitting on a ticking time bomb to the upside. It's just a matter of when. Because this is not, it's like I'm not betting on something that's never happened. This always happened. You can look at I've shown the Barron's Gold Miner Index for over 100 years. There's not a single bear market there that lasts forever. After the bear, you have a big rally. After the bear, you have a big rally. 100 years straight, never failed. Not that it's going to be the same companies, but the sector overall. So we're going to have a bull market after this bear market. That's just how it goes. Knowing that, that's why I can't sell. And of course, I thought it probably started, let's say this is the junior sector. I mean, I thought it started to be cheap here, especially the companies I liked. Did I know it's going to get even cheaper for 2 years? No. I didn't know this back here, and people didn't know this back here, whatever. Did that change the fact that there was going to be a bull market that came after whenever the bottom was in? No. It just meant that if this sector was cheap here, the buys get exponentially better. Right? I mean, this is lower than here. This is the best buy, closer to the bull trend, lower price, insane returns. This is a lower price than here, longer in time as well, so closer to the next bull, insane compounding from here. I mean, this is not even a long time frame. So the longer and deeper this bear gets, the better the buys gets. Because we don't know how long a bear is. We just know the longer it is, the longer it takes. If this wasn't the bottom, this is closer to the bottom at a lower price. And of course it was. If this wasn't the bottom, when we get here, it's even longer into the bear and at an even lower price. So it by default means it's closer to the bull. And of course this ended up being the bottom with the highest possible returns in a quicker time frame than from this semi-bottom or this semi-bottom. But all of these were good buys in hindsight. I mean, you made money on them. It's like if you bought this, you were gonna make money on it. Here, made money. This top made money. This top made money. This top made money. This bottom, insane money. Even this short-term top here, you were gonna make money. This yada yada yada. So I mean, when you look at it, it's like, okay, if you drew a line here, if you just assume this is kind of what's going to happen every time, so let's say we just assume that, the junior sector is going to reach at least this price every single time we draw a line here. You have to wait for a long time, but in a sense, you would make money on every single buy below this point here at some point in the future. So then it gets pretty silly. It's like, how can you actually lose money in this sector? Well, you're gonna lose forever if you sell at times like this. And you're gonna leave money on the table if you don't buy at times like this. And I've gone through this a lot of times. At extreme lows, selling is obviously absolutely the worst. Holding is exponentially better than selling. And buying is exponentially better than holding. People, pat themselves on the backs like, I was able to hold through this and not sell, and you get here. Well, compare that to somebody who actually just averaged down for 2 years or something. He's going to make a lot more money than the person who held. The person who sold is going to be, he's going to be out of the game. He's going to sell for a 70% loss. He's not going to be here for the upturn. The holder, if he bought here, he's going to make his money back. The one that bought here and bought all the way down, he's going to make money by this point in time. And that's why I also say that it's not actually the bear markets that kills people. It can kill companies, etc. But if we have some common sense and actually care about value and we're flexible and nimble, and we recognize the fact that cases are not the same, so we value shuffle or whatever, so your portfolio might look different here than here because something has happened that makes all of a sudden 5 insane opportunities showed up that weren't insane opportunities here. And these opportunities weren't as good as the ones you owned here, but down here, they're insane opportunities. So maybe you're gonna make 600% here instead of, I don't know, 300% from holding the stocks you held here at this point in time. Right? I mean, that's taking advantage of what the Mr. Market gives us. For some reason, five companies that you didn't own before, somebody sold them off and they just got extremely cheap, whatever, whatever. That's being proactive, obviously. You're not predicting that the market is going to go down here, but it happens, and then you try to figure out where is the market the most wrong. What cases are most mispriced? Then you obviously want your money in that one because the future expected returns in that portfolio might be 500 from this level, whereas if you did nothing, just held the stocks you bought here, it might be 300. Not bad, and you should obviously buy that portfolio here as well. But there are even better cases out there. And you see this stuff happening all the time. It's like, I mean, if you take this as a longer term case, one could say, I mean, I think Magna fits this pretty well. Started off insanely cheap in 2000. When was it? 2021, 20. Ran up. I still think it was cheap, and nickel prices were a lot higher than they are now. Then the nickel prices started to crash with the Indonesian oversupply, which basically took down the entire sector and made a lot of mines shut down. So it peaked, sentiment peaked, nickel sentiment started to go down a lot. So I don't think it was overvalued. Not that nickel price at the time with Green Hill and all of that. But hey, okay, crashing junior sentiment, crashing nickel prices. Magna went from 1.5 to, I think it went down to 40 cents. And I spoke about this at the time. In hindsight, you might be, in a sense, very happy that this happened because it was an even bigger buy here, I think, than it was here. And if this wasn't really an obvious sell, because it was cheap, but even accounting for the lower nickel prices when the stock went like this, I mean, the value went down, sure, but it didn't go down so much that the price should be at 40 cents, and it was more de-risked at the time. So I mean, Magna, thanks to, it's like, okay, some reshuffling, okay, you have it cheap, it goes up, maybe you reshuffle some because it's like the price to value gap is closing, then it goes down, okay, paper losses from here, obviously. In hindsight, I would have wanted to sell everything at the peak. That's a fool's errand. Nobody knows when the top is in anyway. Nobody can predict where nickel prices is going to go. Nobody can predict where nickel junior sentiment or junior sentiment is going to go. We just find ourselves here. And then we take a look again at the case. Okay, where's the price right now? What do we think the value is? Okay, geez, it's even a better opportunity here than here, for example. Okay, so you have a bigger position, a bigger portfolio allocation to it. And now it's gone up again. So my point is that if you're totally how was I going to put this? Well, I think, I mean, Magna, as I put in this piece, it's a hodl case. So you made money on it today, obviously. If you're a value shuffler, even if it kinda goes like this, I mean, in this case, for example, compare somebody who the only thing he does is he buys when he thinks the sector is starting to get cheap, and he increasingly buys when it starts to get cheap. Let's draw a line here. He buys this sector anytime it's below this line here, and he ramps up his buying the lower it goes below that line. And up here, he starts selling and increasingly sells the higher it goes. He would obviously make money even if this sector just went like this forever. If you have somebody that just buys high, sells or holds low, he's never gonna make money. Same sector, same market, same swings, different reactions to the price to value gaps. So that's the thing. It's not the the point is it's what we do and not the market itself that holds the key to our success. Like this guy whining to me all the time about this sector. Obviously, he bought in 2020, like a lot of people. That's kind of understandable. I mean, I think most people start out their investing journeys doing that. I mean, just imagine how many bought Bitcoin recently for the first time. Or do you think they bought it low? I mean, when everybody is talking and talking about it, I can't see that it's low. But that's how people tend to start off investing. They hear about people making money. They hear about something going up a lot where people are making money. So they think, hey, maybe I should try this investing thing. And maybe I should try it in this particular thing that has gone up. Has gone up. Good recent past. Everybody's talking about it. Everybody's making money. So I buy into that. Okay, that's the welcome to the jungle situation. So you buy here. Okay. In hindsight, not the best timing, and maybe it wasn't even cheap, so from a value perspective, it wasn't a good idea. Then this happens. Most people, I do think, they just give up. They look too stupid and they hear about other sectors that are doing well, where every idiot is making money right now, like every idiot was making money back here on this ramp. And they just repeat the same cycle. They have no strategy. They have price to value is an afterthought. They don't think about that. They don't think about cyclicality. They never looked at a cyclical sector chart like this and figure out that, hey, okay, maybe I bought high, but I should be buying more and more because it's lower and this is going to happen again. No, they don't do that. So they throw in the towel. I mean, I've looked at some, let's say some accounts on CEO or whatever, that they were still in it here and now they're gone. I don't see them posting, let's say. So I think, again, a lot of people have been killed in this move, or given up. They killed themselves, if you know what I mean. I hope it's not going to get flagged for that comment, but you know what I mean. So they're out. They give up. And maybe they sold out here and now they look smart and they think that, they revisit this sector and it's like, oh, I'm glad I got out there because it's down here. Do you think that's going to get them to buy here? No, that's just going to, reaffirm that their decision was good. But meaning that, something that is low can always go lower. So they're getting out. They don't want to get in here. They just reaffirmed that it was good to sell low because it went lower. But the thing is, compare that to someone who started buying up here but ramps up his buying. Down here, he might be down 40%. If he only bought up here, he might be down 60, 70%. But let's say you have some that averages down. So let's say it's down 50%. If you're minus 50% into whenever the bottom is here, take here or here or here or here, whatever, that's nothing. These moves, if you're down 50% here, you're going to be up a lot here. If you're down 50% here, you're going to be up a lot here. If you're down 50% here, you're going to be up a lot here. If you're down 50%, you're going to be up a lot here. Which means, again, that it's obvious that a 50% paper loss is absolutely not terminal, not in a sector like this. It feels shit though. But it's not terminal. But if you think it's terminal, and if you think that means that you've done some terrible mistake, you're going to sell out because you're not going to trust your judgment. You're going to give up. Or the worst, not the worst thing, but you can do like a lot of other people. It's like, okay, they hear a comment like that, and then they don't care about what they own. So maybe they listen to me saying that's like, hey, when this sector turns around, it doesn't really matter. 100% is not a big deal. This sector can do, this was probably a 200% move, for example. It's no biggie. And then they think, oh, well, good. So I'm going to stick to whatever juniors I have right now that you might be down 50, 60, 70% in. Despite the fact that those cases might have been played out. It's like, okay, you bought it for a potential discovery, whatever. Things went sideways. The case is not at all the same. The value is not the same as you had, but you're in them. You don't want to sell with a loss, and you hear it's like, oh, a crutch, like, oh, this sector is going to go up hundreds of percent. So you take the lazy way out. So you think, oh, then I don't need to do anything. So I'm going to hold all these, let's say, failed cases and just wait for the upturn. I'm not saying they can't go up several 100%. I'm saying that's a very lazy way to go about things. If you hold the crap, if you hold cases that failed, there's no real reason why they should ever go up if there is no case. But if you take those 50, 60, 70% losses, for example, in failed cases, put them in non-failed cases that are still cheap, then you all of a sudden have a reason for them to, that money is put in cases that should go up maybe 2, 3, 400%. And if you have free optionality, there's potential for even more than that. That's smart investing. So it's getting long in the tooth already, as per usual. Just want to show this. I have a few more slides. This is just showing that all-in sustaining cost margin, GDX, GDX divided by the gold price. So bigger miners versus gold. So they've underperformed gold. This is where the margins are as of, when can this be, like October or whatever. So since this only goes back to 2018, but I'm pretty sure there are like record margins in absolute terms at least. Let's say at whatever the gold price was 300, and maybe the average miner had all-in sustaining cost of $100, so it's like a $200 margin. That's even bigger than today, but it's like, for all intents and purposes, in absolute terms, gold in the ground is at peak value on a dollar basis. But you don't see that in the gold juniors, for example. It's just crazy. Most PAs, etc., they use $2,000 gold as a base case, and gold is at what, 2,650 or something. That's a huge margin. So if you're buying something that's selling for 30% what the project is worth at $2,000 gold, you might be buying it at 15% of what it's, or at least 20% of what it's at $2,600 gold. That's a huge risk reward opportunity. Compare that to actually buying. Like I remember up here, I think First Majestic was pricing in an even higher silver price than the current spot price, after silver had ran from $12 to, I don't remember what it peaked at, let's say $28. Maybe it was pricing in a $36 silver price. So it was overvalued at spot metal prices. Did that stop people from piling into First Majestics and all other stuff? No, because they thought the stock was, silver was going to keep going up. And they saw the uptrend in First Majestic or whatever, and they thought that's just going to continue. Everybody's making money. The next stop is up here. That's what kills people. No sense of price to value. I remember I sold First Majestic at like $5. It ran to 26 or something. I thought it was relatively expensive compared to other juniors, other producers, at $5 already. And I missed out on 100% of return. That didn't change the fact that at the peak, First Majestic for sure was overvalued. And the next big obvious risk was to the downside, because the only way that you should make money really from First Majestic at this point is if silver just keeps going to $50. So maybe you get a 100% return. Let's say at $50 silver, maybe First Majestic should be worth a double from this point. That's not a great risk reward scenario. It's like, I need silver to go to 50 after already gone from 12 to 30 or something, for what I bought First Majestic at to be worth 100% more. And then, of course, silver went down to like 14 again, and First Majestic crashed. That's not a good. It's like if you need a blue sky scenario to happen soon. Well, not blue sky. I mean, yes, theoretically, blue sky is that silver just keeps going to $200 or whatever. But it's like, let's be reasonable. If you need silver to hit all-time highs again, and that's good for 100% return, no, that's not great. Now you have juniors out there where it's like the blue sky scenarios would translate to like 10 to 20 baggers, and they have margin of safety where it's like they're selling. Imagine if First Majestic up here when silver was 28. If First Majestic was trading like silver was at $16, that's great. You have probable upside just to reach spot price value. And if silver goes to 50, you might make a whatever 8 bagger or something, 10 bagger. That's great risk reward. Great risk reward is found down here, like now. And especially again in the gold space right now. I mean, it's forget about it. It's like look at some of the more advanced. I mean, you know what gold junior I really like right now. For example, I think it's huge margin of safety and a bunch of free upside potential. I just threw this in. I think this is a fun one. I've had a lot of ideas about this. I don't remember them all, but it's like this is obviously a meme in a sense. But it kind of makes sense. I mean, picture you're the typical investor. What would make sense here? Or it's like if you're the marginal investor, kind of makes sense. Your stocks, and that's basically you went full bore in juniors around here. You didn't know it at the time. Nobody knew it at the time. But what we knew is that a big move has already happened. Sentiment is high. Metals have gone up. People are expecting metals to continue higher. People are expecting miners to follow that and continue even higher. Everybody's used to getting easy returns. And then the last buyer is in, and then your entire junior portfolio goes like this, because we went from a bull market, even though short term, to a bear market. And then this is again, or I guess more stock picking type of thing. Well, it doesn't necessarily have to be stock picking. It's like the stock you were about to buy. Okay, why didn't you buy it? I mean, this happens a lot, and I'm gonna go through that a bit in a piece I'm doing as well. It's like decisiveness. The stock you were about to buy. Okay? You're not in it, so you're biased against it in a sense. I mean, every single stock we don't own, we're biased against. That's just how it is. You didn't buy it for whatever reason. Maybe the stock had been, the share price had been low for such a long time that you think, well, okay, there's no rush because this seems to never go up. You think it's cheap, but it's become cheaper. I mean, I see it all the times, like previously hot store, let's say it goes up, tops, goes down, and then you're like, okay, yeah, I'm gonna wait and see when this bottoms up or something. It's like, oh, now the sentiment is turned, so everybody thinks it's gonna go down, and maybe the metals have gone down, yada yada. So you're like being a momentum trader again, and you think, oh, there's no rush. This sentiment is still bad. You think it's cheap. You look at it, it's like, oh, it looks like it's getting cheaper and cheaper, but the stock price is still going down or going nowhere really. So you don't really trust yourself, and you don't have the conviction, let's say, and booms. Not boom perhaps, but it's like sooner or later it starts to climb, and the value you did see, you didn't act on for various reasons, and then you missed out, and then you don't want to buy it. Or maybe you cave in and you buy it when it actually started to run, and then you're just in time for it to join, this pattern here. And the stock you sold. I mean, this is a typical one, I think, where you hold something, you might have held it for a long time or something. It's gotten cheaper and cheaper and cheaper, and at some point in time, you're so disgusted with it. It's like it's only gone down, nothing has happened, and then finally you get convinced. It's like, well, I thought it was cheap, when it was 50% higher, just getting cheaper and cheaper and cheaper and cheaper. And again, that comes back to conviction. You don't really know the case, maybe enough. So finally, you're like, this is never gonna go up. It's down here. Nobody sees, and nobody's talking positively about it. Nobody can see any risk to the upside. It's a dead dog. Dead dog. Maybe there hasn't been news in a long time and stuff. One thing to note, especially if it's a good management team, for example, uh, or you can take that with inflection, for example, right now. You see, it's like inflection it went up on the latest news release. Excitement. It's like, oh, they might have a copper report for it. Then time passes. Time passes. People get more and more bored. The price goes down and down and down without any news. It's just, still no news. It goes down and down. Same with the cyclicality of stock market or the junior sector. Every passing day that there's no news is one passing day closer to news, obviously. And sometimes for somewhat good reason. I mean, there's a saying that bad news travels slow, good news travels quickly. But there are also cases where it's like, for whatever reason, the news just travels slow. If it's assay labs, if it's stuff that needs to be in the news release, or a problem with drilling, or there was snow, whatever. I mean, there's a bunch of different ones. But typically, yes, you have that pattern of like bad news travels slow. The thing is, of course, that whatever the reason might be, the boredom discount is a real factor. So you have these stocks that go down because they get boring. There's no news out yet. No news out yet. Let's say, 1 week. I mean, take inflection. 1 week after the last news release, excitement was pretty high. It's like, hey, they might be onto something. 2 weeks out, it's gradually gone down because more time has passed and there's not been any new excitement. So you're working with the same stuff, and that wanes off. And then people start to get bored. Price starts to go down, and that makes people even more bored. And you also read into it, oh, I guess the last news release didn't actually happen because now, the stock is 30% cheaper than at the top after the latest news release. So it's like, did the value actually go down by 30%? I doubt it, especially since there's no news out. But that's just what happens. And then sooner or later, I mean, sometimes I literally forget that it's like a company that has had no news over like whatever the amount of time is. You forget that, oh, right, I mean, I had an idea. It's like, okay, in whatever, like 3-4 months, eventually there's going to be some news out and you're waiting for the news. That might be why you bought it. And then you almost forget that you're still waiting for that news. And obviously 3 months later, you're much closer to that news item coming. But the stock has been, increasingly boring. The price has gone down as well. So for all intents and purposes, it's a boring stock that looks like a failed case. And then the news comes and you sold before that. And okay, what's the mistake there? Well, if nothing really has happened, it's gone down in price. For all intents and purposes, it's actually a better buy. And it probably is. And then the news comes that everybody forgot was supposed to come, actually comes, and now it's starting off from a even lower price point. So if the value was whatever, value was here, something goes down, or take this one, value was here, price goes down, boredom goes down, but like nothing has changed for values, price just gone down, and then they release some news which puts the value up here. Of course, that's going to revalue much quicker than from this level. It's just funny. It's like that's how it works, and there's typically a good reason for it. It's like there's been quite a few times where it feels like I finally throw in the towel on a stock I thought it was cheap because, like, okay, I'm just disgusted by the case for whatever reason. It feels like it's not gonna go up ever, similar to how this entire sector feels right now. And then you throw in the towel. It's like the next day, they either release some news, or I was the last seller. So I held out all the way to the actual bottom, and then there's nobody dumb enough to sell lower, so there's not going to be a trade at a lower price. Then you feel really, really stupid, because then you go back and it's like, right, I mean, I literally sold something I liked at a 100% higher price or 50% higher price. I sold it just because I didn't have the patience, I didn't stay rational, yada yada. Whereas in reality, I should have bought that stock. But that's on me. Again, it's like lesson to be learned. Patience is probably the biggest edge there is. Oh, I'm just gonna go through this quickly. Let's say average holding period for stocks has shrunk dramatically. I would say it's even lower in the junior space probably. But I'm gonna cover this in the piece. Keep in mind, I mean, you see this, and I think we can all agree that people are getting more and more impatient, yada yada yada. How? I mean, if we see a trend like this, this is the trend of this is the trend behavior of the marginal investor. Holding periods are getting shorter and shorter and shorter and shorter and shorter and shorter. A 40% decline from 2010 to 2020. That's huge. I mean, it's orders of magnitude shorter than it was in 1960. So imagine what that does. I mean, it's hard to emphasize just how important this tidbit of information is, this behavior of Mr. Market, this trend of Mr. Market. Why? Because let's say you were in a junior sector and people's time horizon was 9 months. Okay? People were patient enough. People who looked at a junior case, they looked 9 months ahead. So they priced in all the probable news, all the possible news, etc., that I think at least is up to 9 months out. For you to buy something for free in a sense, let's assume this is a fair market. Now you can buy, current news, the bird in the hand, for much less than it's worth. But let's say the market was fairly priced, but up to a 9-month period. Then you would need to figure out okay, can I read up enough of this case that I have some sense of what news might be 9+ months out, that the Mr. Market is not forcing me to pay for today. So maybe you see a positive thing happening 12 months out, maybe a rule change, maybe a government, whatever it might be. Then you might, okay, I'm gonna exchange my patience that I can look 12 months out. So I have to wait 12 months for that to pay off. And it's not maybe a huge, I mean, you can't fit really. I mean, if there's a blackout period for the market pricing in stuff 9+ months out, and you figure out one news items between month 9 and 12, maybe that's good for a 20% bump. So you have to wait 12 months to get a 20% bump, because that's not priced in now, because the market is priced in the base case going up to 9 months. So you can buy that for free. That's kind of reflected on a risk-adjusted basis, but 12 months out, it's not reflected. If that happens, that you're not paying for today, you think, oh, then I get an added 20% bump, and 20% in 12 months is good. But if you try to convince anybody today in this sector that, hey, buy this stock because in a year you're gonna make 20% on it. No, but I don't think anybody, including myself, would actually go for that. Think about it yourself. I mean, can I write up a case that, hey, I think even if I could guarantee it's like, buy this stock, it's going to be up 20% in 12 months. You wait a year and you'll get 20% return on that position. I don't think there anybody who would read that article that would buy that stock. If they owned it, they would probably sell it. And that's a very good point. Imagine, and then fast forward to today, where let's say it's, I mean, here it's down to zero point 0.6 years, right? So slightly above 6 months. In the junior space, and we're in 2025 now, maybe that's down to, I don't know. I mean, my guess is that I don't think people care about much new. I don't think a lot of people are, let's say, appreciating, or when they come up with an intrinsic value, when they get a sense of what do I think this company is worth, I don't think they're factoring in news that is like, at least most people, news that is 3 months plus away. So think about, I mean, I personally think most people look at the very next news release. That's how they make their decision. Do they think the next news release is going to be good? Then they buy. Do they think it's going to be negative? Then they sell. And that goes for, like, do they think the next move in gold is going to be up? Then they buy gold units. If they think the next move is down, then they sell gold units. I really do think that what were the playing field, the game that Mr. Market and the market is playing is the next news release up to 3 months. And again, it's been increasingly more short term. So like 20 years ago, it might be, again, 6 months up to whatever, or a year up to whatever. Now, we only, I think, have to look like 3+ months out. If we can see net positive news, if we know a case as well, and we can plot like, I think this is going to happen in month 3.5 from now, at month 6, at month 8, and month 12, you're not going to be paying a dime for that today. I don't think so, in most cases. So, a longer time horizon, knowing a case better than the market has never been easier, because it's obviously very bloody hard. I mean, if the time horizon for people was like 12 months out, and you need to figure out stuff that's 18 months out ahead, that's hard, because you have no idea what the sentiment is. You have no idea what could have happened with X, Y, or Z. I mean, the longer the time horizon goes out, the harder it is to predict things. But if the market is pricing in, is focusing on the next news release up to the next 2-3 over the next 3 months, and you only need to have to look out, let's say, 4 months, and already you're starting to be able to buy free stuff. What an edge! What an edge! What a time to be alive! Has there at any point in time been as high of a expected return on patience and long term, and has it been, I mean, that you can literally buy, let's say, net positive news, that's probable news, that's 4 months out, and you don't have to pay for it today? That's crazy. I mean, again, compare that to the other example where it's like, oh, you have to wait 12 months and you can predict maybe kind of one news release that's good for 20% bump. Imagine if you can come up with, oh, I think this news that's 4 months out is going to bring 20%. Oh, I think this is going to happen in like months 6 to 8, and that's going to be 20%. And then months 10 to 12, I think I can see this happening, and that's going to be worth 30%. All of a sudden, you're up to a very, very large return, just from being able to know the case good enough that you can kind of predict that, hey, I think there's going to be some good stuff happening in months 4 to 12, and the market doesn't even care about it today. So yeah, I mean, this is saying that patience has gone up in value a lot. Patience is probably the biggest edge one can have right now. And of course, if you have no idea what you own, if you have no idea what the news is gonna be, you have no idea why you own it, etc., etc., you're not taking advantage of it, obviously. I mean, let's say I put in the time and effort into a case, like, oh Jesus, I've figured out like 10 things that might happen 3+ months out. And you realize nobody gives a shit because it's 3+ months out. The thing with the future is that it's going to be the present. Let's say, again, you have a news release that's 4 months out. Now nobody cares. Nobody buys it up. It's not reflected in the market price. But in 3.9 months out, all of a sudden, that's going to be the next news release. So you traded patience and a longer time horizon for returns. And you should, I mean, we should all just do this on a rolling basis right now. That's a good, I mean, that's how you create outperformance. You play a different game. Oh, I should have, let's do it like this. Let's say this is the time horizon that the market focuses on. This is today, this is 3 months from now. And your time horizon is this, or let's say this. So you see, okay, the market is whatever, pricing in whatever news is going to happen here. But you figured out that, hey, I think there's going to be, I can see 4, I mean, some might be probable, some might be potential, but they can only, I mean, let's say it's, the drilling season hasn't started yet, whatever. It's like some stuff is time constrained. So the market is not pricing in this, but you're pricing in that. Let's do it like this instead. And obviously, I mean, it should be almost like this. I mean, if there's a positive news release that's imminent, that's going to be priced into the full, basically. And the longer it is out, the less people will care, because again, assume that most people want to get rich quickly, get rich tomorrow. So if a positive news release is expected tomorrow, there will be peak interest today. If a positive news release is expected in 5 months from now, there's going to be no interest today. That's the thing. So you buy it today, knowing the case well enough that you think that's going to happen 5 months out. If you are right, you're going to get paid for that. Because they don't care about that news release, you care about today, so it's not priced in. But 5 months from now, it's going to be priced in, because then it's imminent, then it has happened. And when that is priced in, you're going to get the gap from today to that future value. And if you can find cases where it's like, you know the case so well, and you can see, I mean, some juniors don't have any real money, right? They don't have any expected news releases. Then it's very hard to front run something. I mean, if I'm not doing anything, what can you front run, even if it's 12 months out? It's very hard to see anything visible at that point in time. Except for the fact that, oh, I know the sentiment is going to change one day, and, whatever. But that's, again, then you're just really playing the sentiment change. And that's far enough. I mean, some juniors really should pack up shop and do nothing, have no expenses, and just wait for a turn. So then you're front running that turn. But in this case, I'm thinking more company specific. That if there is a company with, let's say, money, with access to capital, and they have different angles, different catalyst events that you can see and figure out way before the market would start to care about them. That's how you get returns. Because let's say the price of the companies here. let's put it like, yeah, whatever. Let's say price is here, and it's going to be trending up because it's going to be accounting for, I mean, the closer we get to these news releases, the more it's going to get priced in. But you see some big potential news items happening, whatever, 5 months to 12 months out, for example. And when we pass this is going to be in the next news release. After this is going to be the next news release. So maybe it goes something like that. And obviously there's going to be corrections and stuff in between, and it's not going to go like this. I mean, typically it goes like up, maybe down a bit, and then up again, and maybe, you know what I mean. But this is a simplified example. Yeah. Maybe not the best. I'm actually going to remove this. Maybe not the best visualization here, but I hope you get my point. So let's say the ending value after the 12 months are up, you think that all of these news items here will have happened and the value should be up here. And if you do, okay, this is probably not gonna, because it's, well, okay, let's do it like this. So this is today, for example. So okay, let's say this is 12 months. And your base case is like, oh, they're gonna have created, even if it started at fair value, okay, the company's gonna be worth, in my base case, 50% more in 12 months. After 1, 2, 3, 4, 5, 6, let's say material news items are out. I mean, given how cheap stuff is out there, I mean, there's obviously news releases. If some company make a discovery, maybe that's worth like 200-300% of the current market cap. So this might be a bad example, but I'm trying to prove a point here, or make a point. So let's say the market, Mr. Market, in this day and age has a 3-month time horizon. So today you might be kind of paying for these 2 next news releases. And when they happen, I mean, if you buy into, and again, we assume it's going to be repriced fairly. So it's like, if you bought here when 2 news releases happen, you're not getting any time arbitrage in a sense. You buy it the day before, it's already priced in, the news comes, nothing really happens. Okay, there's no advantage there really. And then let's say that this news item is 3.5 months out and you don't see a reason to buy it because it's so far out. Maybe the share price would decline. So if you bought here on unexpected news release, it sells off because this is too far out to care about, and you don't care about it either, so you sell at a loss. You buy into the obvious fact or after the fact or whatever the case might be, and you sell out because you're not gonna wait this much. And then when it gets closer to this, you buy in again because now it's starting to get imminent. Okay, it comes, it's already priced in, nothing really changes. Maybe you can hold on. Maybe this is even shorter in time, so you're going to hold off for that. But that's also getting repriced quite quickly because it's short term, whatever. My point is, obviously, the big delta is going to be if you buy. If that's why I have no short term case. I literally have no short term case because there's no edge in that. I have cases where I think there's going to be positive news 6 months from now, 12 months from now, and I'm going to get paid 6 to 12 months from now, because you're not going to get paid for that today because the market doesn't care about it today. But when the so here's today. As time passes, I bought it here and I get all of this for free, and let's say I get a 10% bump from these because this is whatever 1.5 months out, this is 1.5 months up to 3 months out, and it's partially priced in. As time passes, if I bought here, this was my buying, all the rest of this is I'm just gonna hold the stock. Today, part of this is priced in, none of this is, let's say, priced in. 5 months from now, we're here. And now this is the next visible news release. That's going to get priced in or partially priced in. Nice. Okay. Now my return is from here to here because I waited 5 months for the 6 months news. The news release I thought was 6 months out. Now we're at 6 months. Okay, we're here. This is in the past. This is known already. But there's more. I have, and then of course, as the case changes, maybe I come up with even more news releases. Maybe I can see a news release out here. Then there's no, as long as I think the probable future value, for example, I can see it and it's higher than the price I'm paying today, then there's no real reason to sell. But let's fast forward up to here. So I got them paid. I've waited 18 months in the same stock. All of these news items have happened. That was my base case. I paid this price because I saw for this future I saw, let's say, the base case happen. So I was buying because the price to future value gap 8 months out was this large. Let's say it played out like I thought in that, around, or in the ballpark. I made money. I had a very good thesis for it, why I should be making money, because I was looking at all news releases or possible things that could have happened that I could see up to 18 months ago. Whereas this stock was priced at this point in time because of the next news release or the next two. So I traded patience and the holding period for rewards because the future always becomes the present. Okay, then we're up here. Price has done well, stock price is up a lot. Stock price is up a lot, everybody's talking about the stock. Let's say it's getting hot, it's getting recognizable, yada, yada, yada. But let's say now with hype or something, price goes up there. And I think maybe that's on par with value actually. Let's say at that point in time when the future, 8 months from now, price is here, value is here. Then the question becomes, okay, I can't go out anymore. What happens then? Do I see more news releases? Maybe I do. But maybe I don't see them adding that much value because it's so fully priced right now. Maybe let's take a company that was trading at 100 million here. It's up, now I'm exaggerating a bit perhaps, but let's say it's up to $1 billion. And stuff has played out. So the value is $1 billion or $1.5 billion, whatever. Yeah, let's say value is up here, whatever. And price is there. Then it's obviously getting harder and harder for material success. Maybe they at this point in time, maybe the project is mature. Maybe this is a feasibility study with a whatever. Again, a project is mature. It's like, yes, we had success. Stuff played out. But now it's hard to see where is the material risk to the upside from here. Now we have a solid bird in the hand. The market recognizes that solid bird in the hand. Can I see some news items over the next 18 months again that would make this look cheap? Like my scenario I had in mind for 18 months out at this point already. Today, 18 months out. Can I see a similar thing 18 months ahead where I can hold it for 18 months and if my base case plays out, I might make a very good return? Maybe I see there's some, I think this is going to happen and that's going to happen, but it's not going to affect the value so much because the value is so high already. If they make a discovery, take whatever, a large company, it's like, or take, I don't know, Rupert Resources or whatever, it's like, is that undervalued? Yeah, it's probably undervalued. Let's say it's at let's say it's worth 2 billion. It's selling for 1 billion. Okay, I can see it. It's like, hey, there's a 1 billion value gap. That's 100%. And maybe it's a very probable 100%. I'm not saying it is, maybe. But there's stuff out there which like probable 200-300%, and that makes Rupert look a bit soft in the risk reward department. Then the question is, how much would Rupert need to become a five bagger, etc., etc. It's getting increasingly hard, of course, the more mature and more well known and more appreciated a case becomes. So at some point in time, maybe you're like, hey, I mean, I don't really see how this company could add a material price to value gap for the next 18 months out. Well, then it might be time to leave. Not saying it's a sell, it's just that you can find other stuff where you're back down here again. It's very underappreciated, and you see a truck ton of potential catalysts 4 to 18 months out, which the market is not forcing you to pay for today. Then you have a case. But again, if you're like everybody else that basically focuses on today 3 months out, you can never build a solid case on that really, because that's always what's get pretty much priced in pretty quickly. And then you have the fact that again, if people think enough people understand and appreciate and think that the next news release is going to give a big bump, then it's going to go up right up until that news release, and maybe it surpasses fair value and sells off. Opposite happens when people think the next news release might be a a financing or whatever with dilutions, like a full warrant and discount to market. Then there's pretty much in the eyes of Mr. Market, who cares about the next news release, then there's no price low enough to sell. Then add the fact that some people who might want to get into bulk in that stock, in that placement, they want to see the price go lower and lower and lower if they think they can get in. Then they want to sell and put that money into the placement. So then there's no like, even if it's the value is here, then there's no stopping it getting cheaper. So what I'm saying is that the market, as we can see, where was it? No. Wait, am I losing my mind? Oh yeah, this was the one. Shorter and shorter time horizon. So it's like, it used to be that the market was looking at all of this and priced in some of these. Over the years, it's getting shorter and shorter and shorter and shorter and shorter, leaving much more for us who understands a case or does the due diligence. Because, okay, it used to be that the market looked at all of these news items and the price would be up here already because it was pricing in this, and that. And was pricing in, okay, then price would be here, so the return would be from here to here. Now, if the market doesn't give a shit about these, or let alone these news releases, it only cares about this time horizon. Well, again, then price might be down here instead. I don't think I can emphasize this enough. As the time horizon for the marginal investor shrinks, Mr. Market is leaving more and more money on the table for patient investors, and we don't even need to be that patient anymore. Again, my previous example was like, imagine there's a one news release 12 months out from now, then market wasn't pricing in because it priced in up to 9 months or 10 months or whatever. So this is the gap you were playing today, but it took you 12 months to get that. If we're down here, I'm getting this, etc., etc., etc. Huge opportunity. But again, how in the world are you gonna take advantage of that if you don't know the case? If you have no idea what news could possibly be 18 months out, or if it's impossible to see because let's say the company doesn't have any money, it doesn't have any obvious catalyst, well, then it's hard to take advantage of it because nobody can see that far out. You can't even see that far out because there's nothing really obvious to see. But companies that have, let's say, money, have facets, there's stuff happening. I mean, again, my my favorite case right now is, especially gold case, is First Nordic, because I think there's a bunch of stuff that's gonna start coming. I mean, some is probably gonna start coming out soon, like bot results and stuff. Then the market might not care about that. Who knows? But they're planning to drill up to 30,000 meters. So it's like, is the market pricing in 30,000 meters of drilling that might start 3 months from now? Is it pricing in any kind of success in that? Obviously not, I would say. Is it pricing in a Swedish listing? I don't think so. Is it pricing in a deal for Agnico getting operatorship? Is it, I mean, is it pricing out a spin out for Ojärvi? No, I don't think so. So that is one of the most stacked cases I have come across. It's the most stacked gold case I know of right now. I've done months of research, etc., etc. I have a pretty good idea of an immense amount of potential news items that I'm not paying for today. So if the Swedish listing happens, which I think it will, I think that's good for. I mean, it might be really increasingly material the more time passes. Let's say I get 100% just from appreciating the value of a Swedish listing today, when nobody appreciates it really. Okay, then I appreciate the fact that they're gonna drill 30,000 meters, and IDA is a discovery really. I'm appreciating the fact that if they put 5 to 10,000 meters into IDA, it might be a obvious discovery in 12 months. If that happens, I might get 200%. If they make another, you know what I mean? So it's like, if you find cases where there's a bunch of stuff, probable and potential events that you're not paying for, they are just going to add on each other basically. It's like, okay, this might be worth 20%, this might be worth 35, this might be worth 15, this might be worth 50, this might, you know what I mean? That's how you create the potential, in my opinion, for a great case and a great return. You want to stack as much stuff in a case that you see that the market doesn't care about, because if one happens, you might have a good return. If two happens, you might have very good return. If 3, 4, 5, 6, etc., etc., etc. And then we have, of course, the fact that that goes for every junior. You have the sentiment swing in our back pocket. But again, I'm not creating or be excited about the company. The sentiment swing is universal anyway. So it's not. You don't buy crap because I'm waiting for a sentiment swing. You might as well buy a great case where you have that as well, plus a bunch of other things. I hope this should make a lot of sense. And that is again, this is basically paid for patience. We're betting on the fact that we have an idea what's going to happen in the future, that the market doesn't care about it today, and then we hold it until the future becomes the present, and then we incrementally get paid and paid and paid and paid and paid. The price and value gets walked up, walked up, walked up, and when we look back, this today, the more events have happened between now and today, net positive events, the more we should make on our investment. Compare that to somebody who jumps in here. Even if all of these things play out, more stuff is well known, so this guy is paying this and he's catching that. But if I bought here, I take full benefit of all of these, and my gap is from here up to here instead of from here up to here. So, and management plays a big part in this, because a good management team tend to, future surprises tend to come to the upside. And the only way, if you give a good management team 24 months to do stuff, If you knew nothing else, you didn't even know what the possible news releases would be, but they're a good team. You buy it today, come back in 2 years, there might have been, events like this, and you're up a lot. Opposite for a bad management team, let's say, not necessarily, but I mean, in theory, that they're gonna create destroy value. They're gonna mess things up along the way. So if you buy it today, knowing fully well it's a crap management team, let's say, and let's say you start off by not buying it cheap, or the sector is not even cheap. In 24 months, you should almost assume that you're gonna be down or value has been destroyed, because they're gonna find, if you give them enough time, they're gonna be able to destroy value. I think this is incredibly important. That's it. Long. I didn't even plan to go into this rant, but I think some of these rants, concepts like this, when you know come up with them on the fly, I think they might be the best ones. But I hope it makes sense. So that's basically, to sum this up. Our biggest edge is looking further ahead of the market, and the market has never looked less far out than today. But again, key point here is that is why you have to, because let's face it, I mean, the more stuff you see in the future, let's say you're looking at this case, you're appreciating this, and this, plus these. All of these you synthesize to your estimation of what the case is worth. The market is not appreciating this. So you're gonna feel like you're going crazy. You're looking at all of this and have an opinion of what is it worth. The market is only looking at this and this plus the current sentiment, and it's pricing it here. Maybe you think the value is up here, based on what you think is going to happen over the next 18 months, while price is down here. You might feel paranoid. It's like, I don't understand, how can the market price all of this at this price? Because you're looking at all of this and you're pricing it up here. But again, that is because the market doesn't look at this. They will, when we go from here to there, then they will appreciate all of this. And that's when you get paid. So we want to front run as much stuff as we can, that the market is not having to, making us pay up for it now. That's why some of these cases out there, I think, especially when you can plot some of these possible events, it's mind-numbing. I mean, the cases are absolutely batshit insane, I would say, but it makes sense. We have shorter time horizon than ever. We have seasonality. We have record high value of gold in the ground, while the prices are down. So everything makes sense that this is a generational opportunity, and a generational opportunity for the longer term value investors in this space. So yeah, I mean, that's about it. This is not the time for short-term cases. If you have a short-term case, you probably don't have you might have a case, but that's where this is a crowded area. The next news release out to 3 news releases out is a crowded area. The great thing is, even if these are priced in today, that the value is going to be here in 3 months, it's not pricing in that. So 3 months from now, it might start to. Anyway, it might start to price in the next news release, so you get a bump. So again, it's like, it doesn't really matter that much. I mean, you would want it to be really cheap today. I mean, that's why I like the birds. I mean, seriously, if we're thinking like the margin of safety plays. It's not like they're fairly valued. It's like prices here, margin of safety might literally be like hundreds of percent higher. Then you have all of these things that's like potential positive surprises. I mean, it's absolutely insane, the risk reward in some cases right now, where it's like you're buying the known stuff for less than it's worth, and you're getting, I don't know, 10 probable net positive news releases or potential positive news releases for nothing. So you have like, this is a price to value gap you're just waiting to close, and then you have like, I don't know, 15 news releases over the next 12 months that can add to that. Yeah, anyway, that's it, long rant. Consider me biased. I own shares of most companies I mentioned. Some are banner sponsors maybe as well, so in that case, consider me twice biased, not investing advice, not buy recommendation, not sell recommendation. You know the drill. We don't share, our profits or losses. So I mean, if you don't see a case, don't buy it. You get my point. I mean, I'm trying to point out the facts. Like, you should know a case well, and in my opinion, be a stock picker. It's like, I'm much more excited for the what the companies are priced at, what they could be worth in the future, than I am what I think silver and gold is going to do in the short term. Yet that's basically what everybody's focusing on. Everything is short term. So that's why I don't think you should really. I mean, if there was any time you shouldn't have, you should really don't have short-term cases, it would be now, increasingly so. Because everybody, I mean, more and more emphasis is on the very next news release, and especially if it's an obvious news release, and especially if the consensus is that, it's for sure going to be positive. Now, the good thing about this sector right now and the sentiment is that there's so few people out there who care that a lot of, unless it's a very hot stock, you might not even be, the market might not even be pricing in a pretty imminent positive news release. But I mean, take a time travel machine. Take whatever junior you hold, have an idea of like, okay, I know what people are saying and feeling for the stock today. If I can imagine, what's the talk gonna be 6 months from now? What news do I think could have happened by then? What news do I think might be still to come over the next 6 months? What's the feeling gonna be? What's the narrative of the stock gonna be? Do I think that company in that future 6 months from now, will this price today be the sentiment, the sentiment, because I mean, let's face it, a price is what people feel it's worth, if you know what I mean. What's the emotions going to be in 6 months? If all these things happen and all these are still yet to come in 6 months from now, will you look down, or will you go and check the market cap? Is it going to be higher or lower or the same as today? If you think it could be materially higher, then you have a really, really good case, especially since, like, personally, my goal is to compound, and that's not going to be possible over the long term, but it's like I'm aiming for 50% per year. Yet you could probably not get anybody if you said a case, you're going to make 50% in this in a year. It's like, well, that's not interesting enough. I mean, I think some juniors out there, or many, could do a lot more than 50%, but that's what it is. I gotta go. Thanks for listening. Bye bye.